Welcome back, Inspired Moneymakers. You're tuned into the Inspired Money live stream podcast. And today we have a topic that has the power to transform your financial future, creating streams of cash flow through passive income. Imagine a life where your money works for you, generating income while you sleep, travel, or pursue your passions. Sound too good to be true? Well, it doesn't have to be. And today, we're going to show you how to make it a reality. Passive income is the golden ticket to financial freedom. It's the key that unlocks the door to financial stability, allowing you to break free from the 9 to 5 grind and design a life on your own terms. Whether you're dreaming of retiring early, traveling the world, or simply having more time to spend with your loved ones, building multiple streams of passive income is a potential path to achieving those dreams. In this episode, we're going to explore the foundational sources of passive income, things like real estate, dividend stocks, and online businesses. Real estate has long been a favorite for building wealth and generating passive income. We're also going to discuss the potential of digital platforms because the internet offers endless opportunities to create passive income. People are creating businesses driven by e-commerce, affiliate marketing, and content creation that can generate revenue. So get ready to be inspired and empowered. Whether you're just starting your financial journey or looking to diversify your income streams, this episode is packed with insights and actionable tips that will help you take control of your financial future. Before we get started, this episode is brought to you by my financial advisory firm, Runnymede Capital Management. I want to invite you to do a 3-minute plan that calculates your max retirement income. If you're curious to see if a financial plan can help you feel more in control of your finances, doing a 3-minute plan is a great way to start. It's free, and you can check it out at inspiredmoney.fm/getplan. That's GETPLAN. It'll just take a few minutes, and you'll get instant feedback. Then we can follow it up with a one-on-one call. I'm happy to point you in the right direction. So I'm excited that you're here with us to explore this topic of passive income and financial freedom. Together, let's welcome in our panel of experts. We've got another great one for you. Let me start with Michael Zuber. He's author of One Rental at a Time, a story of working full-time and building a real estate portfolio that eventually replaced 2 6-figure incomes. He successfully made that leap from W-2 to financial freedom, and now spends his time helping others to see what's possible with just a little focus and daily discipline. Michael, welcome to the show.
Thank you, buddy. I really appreciate that opportunity. I love talking to W-2 employees because the job can be seen as a key or a prison. It's just your mindset. What do you think it is possible? So thanks for the opportunity.
I look forward to diving into that power of that mindset shift and, seeing things differently. We have MC Laubscher back on the show. He's a wealth strategist, host of the Cashflow Ninja podcast, and CEO of Producers Wealth. He's known for his expertise in alternative investment strategies and creating sustainable wealth through financial education. MC was a guest on the podcast back in 2021. You can go to inspiredmoney.fm/210 to listen to that one-on-one. MC, it's great to have you back.
Thank you so much for having me back on. It's great to be here, and I've been looking forward to this discussion.
Yeah, the power of cash flow.
Absolutely. Cash flow can provide the life that you envision for yourself. So it all starts with that vision that you set out for yourself, and then you build the rest of the pieces of your life. So it's lifestyle by design.
Right on. Next, we have Colton Lukey. He's a real estate investor, entrepreneur, and educator. He specializes in teaching others how to build wealth and generate passive income through strategic property investments and more. Colton, welcome to the show.
Hey, Andy, thank you so much for having me. Looking forward to it. Cash flow equals freedom. It's something I live by and something I love to help other people understand so they can reach their financial goals as well.
Freedom is powerful. And then rounding out our panel today, Dustin Heiner is back on Inspired Money. He's a real estate investor, entrepreneur. He's founder of Master Passive Income, where he teaches others how to achieve financial freedom through real estate investing and creating multiple income streams. Dustin was a panelist back in November for an episode entitled Building Wealth Through Real Estate Investment. That was with Rich Carey, Eric Yu, and Crystal Hammond of Stacking Deeds. You can go to inspiredmoney/live13 to check that out. Dustin, welcome back.
What's up, Andy? Thank you so much for having me on the show. I love coming on here and just chatting about different ways that we have passive income. Obviously, I'm real estate investing. I love the term successfully unemployed because once you're working that just over broke job, JOB, that's what it stands for, because you're living just over broke. Once you find out that passive income is something that you can use to change your life, get financial freedom, at least I didn't go back. That's the only thing I go for, but I appreciate you having me on the show.
With that freedom, what are you and your family up to this summer?
Oh, my goodness. So we literally just got back from 2 weeks in Japan. It was a spur of the moment trip. My brother and my dad were going, and they said, "Hey, would you want to go?" And I said, "Okay, let's go ahead and do it." And I traveled with my family to Japan's, and I literally did not have anything to do with my businesses. My businesses, they were running themselves. All my real estate that I own made money for me while I was working. And the great thing is, so a lot of people heard the book, The 4-Hour Work Week. Well, the premise of the book is great. Try to design your life so you only have to work 4 hours a week. Well, I don't want to work 4 hours a week. I don't even want to work 4 hours a month. I think working 4 hours a week is for suckers. I maybe work 4 minutes a month because I have other people, experts, doing all the work for me, like property managers and everybody doing all the work. But with that, I don't have to work because I have experts doing all the work. But as far as me, it's literally going to the gym, hanging out with the family, going and traveling, and just having a great time.
I think that once again, as I listen to this episode, I'm going to have a wake-up call saying that I am doing things all wrong. But I love Japan, love just a great bowl of ramen, and Japan's just an amazing place. I was there in 2019 with my family and all my kids. They're still talking about it. They want to go back. So I need to generate some passive income so that we can go there and money is being made as we tour different cities. So I'm so excited that everyone is here to join us, whether you're watching on YouTube or LinkedIn, Instagram, Facebook. Drop a comment just to say where you're watching from. I'm so glad that you're here. And we're going to jump straight into segment 1.
Achieving financial independence often hinges on generating passive income, which allows earnings with minimal ongoing effort after the initial setup. Key sources of passive income include real estate, where purchasing rental properties provides steady cash flow through tenant management and property upkeep. Investing in dividend stocks also offers consistent income, as companies distribute portions of their profits to shareholders. Online businesses present another avenue, generating revenue from digital products, affiliate marketing, and content creation. Additional sources such as peer-to-peer lending and royalties from intellectual property diversify income streams. Real estate strategies require substantial initial investment, market understanding, and diligent management for long-term benefits. Successful investors focus on education, planning, and building a robust team. Ultimately, passive income brings financial stability, accelerates the achievement of financial goals, and opens the door to early retirement, guiding individuals toward greater financial freedom and security.
So maybe we can just start with like a quick round, starting with Michael. What do you believe is the most accessible source of passive income for a beginner, and why?
It's funny, when I think about this question, it actually goes back to living below your means. And what do I mean by that? All of us, in order to get passive income, this foundation, this financial base, you have to have seeds. And for most of us, myself included, that meant I had to go work a job, right? Just over broke, as was said earlier. I had to find a way to create discretionary, disposable income, money left over at the end of the month, that then I could stack and ultimately buy assets that would produce, passive income, cash flow, and ultimately the ability to hold those long term, right? That's what I did for 15 years because I was working 60, 80, 100 hours a week. That was the only option I had. Now, I happened to retire at 45, find online, right? I wrote a book, produces thousands of dollars a month. I have a YouTube channel, thousands of dollars a month. Courses, same thing, affiliate marketing. So I don't think it's ever been easier to do online, side hustles or passive income. I can tell you writing a book is the ultimate passive income. I haven't done anything in 5 years and money still shows up. But as a W-2 employee, Gen X, growing a family, I only had one option, or at least it felt at the time I only had one option, and that was to buy, rental properties and slowly but surely build over years and decades.
MC, what are your thoughts?
Yeah, Michael made a lot of great points. I think my answer would be there isn't just one specific one, and there shouldn't be. So I think Michael gave a pretty good just foundational piece of advice for folks that are looking to start is first, you got to fix your economy. So first you got to make sure, what does the cash flow look like inside of your personal, your business and investment economy? And you got to start with your personal economy. So the first thing you need to do is make sure that there are no cash flow leaks and you have systems in place, a very intentional plan for money flows inside of your own economy. Otherwise, it's just going to be a pipe dream, right? You actually have to take action and do that. So the first thing is get your house in order. Make sure that the cash flows is structured and there's a plan for it inside of your own economy. Fix all the cash flow leaks. Then the second thing is you start with assets that interest you, that inspire you, that really gets you excited. For me, going back now, what is it, 2001? It was real estate. It was single family real estate. So that's just where I started. But I think as you grow and develop, you start to learn more about other assets, which are very, very similar, whether it's businesses, some insurance, digital assets, books, and courses, and more. So I would also just add that when it comes to financial freedom, a big part of what we talk about is financial freedom. And freedom is one thing, but sovereignty is also another thing that we forget about that part. So I always share, and we share in our community and in our network, that yes, financial freedom is great. And that is eventually when you have assets that produces income monthly, consistently, that pays all the bills and then some, right? But to be actually financially free and sovereign, you have to have diversified income streams. I think the biggest lesson from 2020 for folks, and for me personally, is having diversified income streams, because one could be taken away in a second, and then you just don't want to be just reliant on one. You want to have many of them, and many in different asset classes and different niches. So, and obviously some of them can also be positioned as a hedge, for example, if something happens to one of your other income streams.
So I'm hearing that, spending within your means, having cash to put to work, that's the starting point. Dustin, as we look at, do you have a suggested starting point? And maybe what I want to ask you is, what advice do you give to somebody looking to transition from the 9-to-5 to a passive income world?
For me, what it really comes down to, because I love what both Michael and MC both said. I also love multiple streams of passive income, but I didn't start with multiple streams of passive income. Now I'll get to that in just a second. But now that I have many, many streams, I can't even count how many streams of passive income comes in. They just keep coming in. All these streams flow into my river of income, which is my real estate investing. So that's where I keep the most money. I make the most money. It's generational wealth. I'll literally give it to my kids. So they flow into the river, though. And the reason why I say the river is because that's where I make, number one, the most money, and I have the least amount of work come out of my time. Now, if I write a book, I think, Michael, you're 100% right. Books are fantastic. Amazon just sells it for you. But at the same time, you have to keep writing books too. Their passive income is where you work one time and get paid over and over for that one time, but you still got to do some work a little bit here and there on every single stream. Now, if I were to get started all over again, I would find my bread and butter. Now, my personal bread and butter is residential, just like Michael. I love the title, One Rental at a Time. I started in 2006 just buying one after another after another. And eventually, $500-600 a month in passive income from each property, you have enough money to stop working. But it's hard to start there because people think, well, you have to have a lot of money to get started. If I were to start all over again, I would literally start making money online. That is by far the fastest way to start making passive income. It is so fast and it generates money very, very quickly. Then I would also personally focus on using that money that I make to get more assets, to make more money in passive income. I literally have 5 businesses now that are passive streams of income for me. But at the same time, it's not like I don't have people do work. I literally have experts. I have people that are great at their job. They do the work, but it's passive for me because it's not my time. So if you build a business that is online, that's a great way to get started. Start generating revenue. Then keep compounding on that. And then I would definitely suggest once you start making enough money where you can now put it into assets, you hopefully reach financial freedom. And one quick last thing I'll say is financial freedom is just the starting point. It takes the longest to get there. But once you get there, that's the starting part. Then your life takes off because you have 40 plus hours of your life back that you could then put towards your businesses, towards your family, towards your relationships, towards serving other people. Because I find the more people that I serve in this life, the more money I make and the more money other people make and the better everybody's lives get. So that's what I would do to get started.
I love it. Colton, I don't know if you're the youngest guy here. Your thoughts and any strategies to ensure this like continuous growth and scaling of passive income over time?
Yeah, absolutely. So I think I'm going to go against the grain here a little bit. To answer your original question about what's most accessible passive income, just from personal experience, when I was 16, my father opened up a brokerage account for me and I bought a couple of shares of American Express and I received a dividend. There was nothing I had to do besides click buy and wait. And every 3 months I got a dividend. And I think dividends are the most accessible because for as little as whatever it is, $20, $30, you can own a share of a company or an ETF and get paid either monthly distribution or quarterly dividend, whatever it is. Another thing I want to bring up is we are in a digital age, as everyone knows, and technology is always changing, it's advancing. And one thing people need to be open to is also different types of investments out there. I personally have been investing in Bitcoin since 2016, but I don't promote it very often because very few people understand it. They just automatically, push it away. It's a scam. But I think understanding that now that the biggest asset manager in the world is owning it and believes in it, people really need to start taking this stuff seriously. So another form of passive income, maybe this is for the younger generation, but it's really open to anybody, is again, there's things like crypto staking, where you earn money by verifying transactions on the blockchain. Again, very passive. You click buy and you wait for to come in. But those are very easy ways to get started in investing. It's a brokerage account and it's a couple bucks. When you start building up money, an online business, absolutely, right? Fantastic. You maybe need $1,000 to get started, maybe less, maybe a little bit more, whatever it is. But the ultimate wealth builder, in my opinion, is still real estate because you get the leverage, you get the appreciation, you get the cash flow, tax write-offs, endless amount of positives. But I believe there is a buildup for that. Me personally, I never made more than 60 grand a year. So it would have taken me 25 to 30 years, most likely, to become financially free in dividends, where it took me 6 years with a combination of dividends and real estate, and 90% of that came from real estate. So I just wanted to throw another little thing out there that dividends are, in my opinion, the most accessible and the easiest and the lowest amount of money required. But the ultimate wealth strategy, I still think, is real estate and then long-term holders of Bitcoin.
MC, you also explore like crypto, right?
Yeah, that's correct. So I actually have researched over 90 different passive income generating cash flow niches, and I featured them in in a book series that I wrote. There's 3 books already published. There's a 4th one on the way. So I've looked at all of these different cash flow niches, and like Colton makes a great point. There are so many different things, and just back to what I said, it's all about what you're interested in. And there's so many young people in their, I would say they're 19, 20, 21, they're in college and so forth, that start out. They get pretty excited about crypto because that's kind of their thing, right? It's like when I was just out of college, and during college, it was the internet thing. It was the .com bubble. So everybody was looking to figure out how to start, online businesses and start these buy up a .com and see what happens. So it's the same thing with crypto. I think it's very exciting for young people. And I think like the upward mobility, if you're smart and you really, really, really invest your time and learn and become an investor in crypto, not just a gambler or a speculator. You're not hoping for to hit the next doggy coin or crypto kitty or whatever's out there. If you're actually become a professional and an investor, and you hone your craft and you get better every single day, and you're young and into it, and this excites you, I think the upward mobility that's available there to a generation which largely has completely been rug pulled, right? If you're like 18, 19, 20, 21, you want to talk about a challenge, a mountain to climb to get started, as opposed to other generations. So I think crypto is a great mechanism for upward mobility for folks getting started and excited, and at the right time when this ecosystem is really taking off.
I love it. And I think that part of this, it does point to like what Robert Kiyosaki talks about, owning assets, accumulating assets versus buying things that are going to depreciate over time and not retain any kind of value. And Junaid in the comments shared he never thought about a book as a passive income stream, but it is, right? Because your book can be considered an asset. You write it once and it can be selling over time without you having to write that one book again and again. But then it sounds like MC and others, you guys are writing multiple books because then you're generating multiple streams of income just based on those books.
Well, let me add one thing with the books. That stream of income is great, but it's also a great way for people to want to either work with you. Let's say you had an online business. Let's say you're trying to help other people to, like, I have my book, and my books, actually multiple books, they literally help me to reach more people who may want coaching, or they want to come to my conferences that I put on for real estate investing. And so what I like to do is utilize my book. I literally just give it away for free. Now people buy it. I make money from it, which is great, but it's another way for people to find you for whatever else that you're going to be doing. So I love that you can easily write a book, and then at the same time, you get seen as an expert in whatever field it is that you're writing that book on, because, oh, you got a book, but it's so simple, gets you passive income, gets you going, but then it puts you as an expert and hopefully elevates you in whatever else you're going to be doing with your businesses.
It definitely opens up more doors.
Yep. Yeah, you have to know how you're using your book. So I love it. We definitely have 4 incredible panelists here. I think all 4 of you are real estate investors. So let's go to segment 2, talking about real estate.
Real estate can generate earnings from property investments with minimal active involvement. Key strategies include owning rental properties, participating in crowdfunding, and forming partnerships. Rental properties, whether single-family homes or multi-unit buildings, provide steady cash flow, but require significant initial investment and ongoing management. Commercial real estate, such as office and retail spaces, offers substantial income, but demands more expertise and larger capital. Crowdfunding platforms allow investors to pool funds for larger projects, reducing entry barriers and spreading risk, while partnerships leverage combined resources for more complex investments. Short-term vacation rentals through platforms like Airbnb can yield higher returns, but need active management and regulatory compliance. Benefits of real estate passive income include consistent revenue, property appreciation, tax advantages, and diversification. However, it involves upfront investment, market risks, and management responsibilities. With strategic planning and informed decisions, real estate can be a robust source of passive income, enhancing financial security and independence.
Colton, you mentioned dividend stock investing because it has the lowest barrier to entry. You could have like $20 or $30 and get started. When you accumulate more money and you're thinking about diversifying into real estate, how do you identify promising markets for real estate investment that can offer the most potential for passive income?
That's a great question, Andy. So I have invested in two markets. So my first market I invested in was essentially my hometown, my backyard. And I got started with a house hack. So for the individuals that don't know what that is, you buy a property of 2 units, 3 units, 4 units, you live in 1 unit, you rent out the other. Now, the reason why I did that, again, I was a very low earner. I couldn't afford to buy a regular house, and I had to buy something that brought in income because here in Canada, the bank will use some of that income to help me qualify. And that was the only way I could actually get into a property. So what I did is bought a duplex, lived in the basement apartment, renovated it, rented out the upstairs. I lived for free. Now, was it the best area? I have no idea, right? It was close to home. I kind of knew the area. Was it the best? Again, I don't know. But I think a lot of people get caught up in social media and they see people investing in all these big cities and all these big towns, and they think that their own small hometown isn't profitable, isn't the right thing. And I can tell you that only investing in small towns, I have become wealthy doing that because there's less competition. It's easier to get into properties because of their valuations compared to the big cities. And as we're seeing this trend, and I noticed this trend a long, long time ago, which is why I stayed to small cities, you see people from the big cities moving into the smaller suburbs because it's more affordable. And that trend will continue as inflation continues to go high and currency debasement continues to run rampant. You're going to see people flood to where it's cheaper. So my second phase was we ended up selling all of our properties in Ontario, Canada, which was where I was living, and we moved everything to the East Coast of Canada because we saw that now where we sold properties for $500,000, $600,000, $700,000, we can now buy those same duplexes for $150,000, $200,000, but the rents were constantly going up. And we also saw that the potential for value and migration was continuing to go out that way because of affordability. So I would say for individuals looking to get started in real estate, look in your backyard, become an expert in that area, talk to real estate agents, talk to mortgage brokers, start a meetup. There wasn't any meetups in my hometown, so I started my own meetup on Facebook, and then we met at a local bar every Tuesday. And you're going to become an expert very quickly. And that's, in my opinion, the best way and the best place to get started is your own backyard.
Michael, can you discuss the advantages and disadvantages of single-family homes versus multi-unit buildings?
Yeah, so as somebody who owns both of them, there's a couple of pluses and minuses. You know, single-family homes, generally speaking, are what most people understand. It was certainly my case. However, 1031ing or selling or exchanging from houses to smaller multifamilies, you need to understand there's certainly more management headaches, right? When you start having shared walls and parking and all of those things, part of the management becomes, being a counselor. So definitely, if you only have experience with houses and you're going to jump to a fourplex or a 10-unit building, which I have, realize that the management the management work is going to be more. Turnover is going to be certainly higher. The landlord's going to be responsible for more expenses. For example, in a house, the tenant owns electricity. In a multifamily, you may be responsible for some electricity in common areas and things of that nature. So realize that if you're going to make the leap from a house to small multis, the lift is not as easy. That's certainly a mistake I made at year 5 is I thought they were all the same and they weren't.
It's good to know a mistake to avoid. Dustin, what's your approach to evaluating and selecting profitable rental properties?
Well, what it comes down to is every single type of asset class, you're going to have good deals and bad deals. And so I have students that come and I as I'm talking to them, they'll say, well, Dustin, should I look for this type of deal or this type of deal, or like a single family home or a duplex or a tribe? And they throw in all these ors, like, should I do this or that? And I say, it should not be an or, it should be an and. And the reason why I say that is you have no idea what deal is going to come your way. Now, I'm not saying you should jump right into multifamily. You know, I just literally just closed on a 355 unit apartment complex, which is going very well, but I didn't start there. A lot of people say you can start at multifamily, which I don't think you can personally. It's too hard to make money to get financial freedom with multifamily because you have a lot of other investors. It's just a whole nother ball of wax. But when you buy a rental property, you can actually get cash flow so very fast. You can rent it long term. You can rent it midterm, 30, 60, 90 days. You can do short term, which is like Airbnb. And you could also do a co-living where you rent out per room. So there's so many great ways to make money. But you should not be looking at, should I just focus solely on a single family home? Well, you can. But what if a duplex come your way and you're like, well, that's not the one I was looking for? Well, there could be fantastic deals that you are passing up. So my suggestion, if you're going to be looking at a specific city where you're going to be looking to invest, and I think Colton's very, very right. Every city is going to have great areas to invest in. Don't write off areas that you might be thinking, oh, it's just too expensive or it's too this or too that. No, there are deals everywhere. And to give you one quick example, we just bought a 355 unit apartment complex. It's right near Nashville, but we got it 60 cents on the dollar because the seller was distressed, which means they needed the money for another project. And they came to us and said, hey, we want you to buy it from us. We're not even going to take it to market. Well, we weren't even really looking for this deal, but they brought it to us and said, we're going to sell it to you. We're going to double our money because we bought it 14 years ago, but you're going to capture a lot of equity because you can close fast. So we got it 60 cents on the dollar. So what I'm saying is if you're going to get started, you want to look at all types of deals. Now, I personally suggest single family homes are great, 4 units and below. Residential are terrific because you can start getting, you get regular conventional loans. 30-year fixed are fantastic because your interest does not go up, your payments don't go up. What happens is you pay it off over time. Eventually you own the property, you can give them to your kids. So if I were to get started, I would look at all types of deals from 1 to 4 units, and then at the same time, be figuring out who could be your mentor. Who can you learn from? Like more than likely, everybody here is going to have some experience that can help you to walk you through the process of doing it successfully and having, and I suggest, don't manage the property yourself. You hire other property managers. And when you hire those property managers, you account for that expense before you buy the property. People ask me, Dustin, how do you afford a property manager? Like, I don't afford it. Like, I don't have to get a job to pay for the property managers. I buy the property knowing I have a manager paid for before I buy the property. So that's what my suggestion is. If you're going to get started in residential, 4 units and below, you can successfully do it very, very well.
How about you, MC? What strategies do you recommend for diversifying real estate, and how do you minimize risk?
Yeah, so for me, is I'm always trying to see where there are blue oceans, as opposed to the red oceans where all the sharks are fighting over some of the scraps and there's a lot of blood in the water. So sometimes you have to get very creative. So I'll share an example. This is very interesting. So I always said jokingly, if you want to get into, if I had to really pick 3 businesses to get in right now, again, if I had to start over, probably be babies, weddings, and maybe divorces. You'll never run out of business there, right? Now, again, you have to figure out which one of those are going to be something that you enjoy, something that's interesting. So what I found very interesting is looking at the real estate landscape. And I saw what was going on in single family. I saw what was going on in multifamily. It got extremely, extremely hot at one stage. And what we looked for is a niche that was very distressed. And the niche that was extremely distressed was hospitality. And this was even slightly before 2020. The economy already started going down in 2019, especially when it comes to disposable income. So it helps when you inject $4 trillion into it. That solves a lot of problems, right, with disposable income. So we already looked at distressed hospitality properties. And then inside of that niche, there's another niche of historic properties. Now, why historic properties? Historic resorts and hospitality properties. Well, they're unique. They've been around for a very long time. They have a soul. They have a story. There's an angle to them. There's an allure. There's something that draws people to them. So what we try to do is we looked at some of these properties that we can actually bring the business plan. And my vision of the babies, the weddings, and the divorces, I was going somewhere with this. We actually brought in a business plan where we had wedding venues on one of the oldest historic properties. And we acquired this in 2019. And of course, 2020 happened. And I mean, the travel habits and behaviors of people changed. Instead of taking your entire family and all of your friends to the Caribbean and having your wedding, you are now looking locally to a place where everybody can drive, and mom and dad and your grandparents and everybody can be there. So we started buying all these historic properties, mostly in the Northeast, which is very specific, very, very, very overlooked. It was very challenging too when it comes to the financing, because nobody would touch it, right? Nobody would touch hospitality during that time, which presented another opportunity because nobody got involved. A very blue ocean. Nobody got involved in hospitality because it was getting clobbered. Nobody got involved into specific historic properties because they couldn't find the financing. So you had to get very creative, do a lot of seller finance deals and so forth. And essentially what you have is you have a nice piece of real estate. Some of these resorts, there's one particular that I'll share. It's one of it's a second, depending who you are, it's the second or the third oldest winery in the United States. It's about 20 acres. It's now a wedding venue, number one, but you have many, many other sources of income. So your main core business is weddings, which they're never going to stop. And people don't stop spending money on them, by the way, just like babies and dogs and maybe divorces too. Because some of them, I guess, are worth it. But people don't stop spending any money on it. So then on the property itself, there's a hotel, which then people have to come to this the wedding. So they stay there. They have to go to restaurants. It's a winery. So you're selling wine and doing wine tastings. And there's different food options. There's other banqueting events. There's a golf course. There's a spa. I mean, and then an outdoor village which was as a result of the 2020 events. So you have all of these ancillary income streams now based on one. So that's one way of diversifying within real estate, is looking where there's opportunity where others are not looking, and try to find blue oceans amidst the sea of red oceans.
I love that. And that's got to be Renault Winery, right?
That's Renault Winery, yes, with Josh McCallan and Accountable Equity. Yep.
Yes, Josh has been a guest talking about wine. I didn't actually have him talking about real estate, but he definitely could have.
Yep, absolutely, yeah. And a winery is just one example. There are other examples of other properties where they have a different edge to them, something else unique, right? But that's a great example, because the cash flow on those types of strategies, real estate strategies, is quite incredible.
I love it. Well, we covered from single family, multifamily to hospitality, much bigger venues. Let's move on to segment 3.
Digital streams of income harness the power of online platforms to generate revenue with minimal ongoing effort after the initial setup. E-commerce, through models like dropshipping and print on demand, allows entrepreneurs to sell products without handling inventory or shipping logistics. Affiliate marketing offers a way to earn commissions by promoting other companies' products, relying on a strong online presence across blogs, social media, and websites. Content creation, such as YouTube channels and blogs, provides monetization opportunities through ads, sponsorships, and merchandise, driven by consistent, high-quality content. Additionally, selling digital products like ebooks, online courses, and printables on platforms like Amazon Kindle and Etsy ensures ongoing revenue with minimal post-creation effort. Other avenues, including selling stock photos and videos or developing mobile apps, offer income through royalties, purchases, and ads. By identifying a niche, planning strategically, and producing quality content, individuals can create sustainable passive income streams in a number of different ways.
Michael, how do you see the role of digital products in complementing your more traditional real estate investments?
It's been a wild experience for me because unlike these other gentlemen, I happened to get into this space completely by accident. So my story is a W-2 employee. I retire in 2018. I'm bored. I don't know what I'm doing. I have no plan, but I have enough money to do whatever the heck I want. So I go from being extremely excited to retire to being depressed. Ultimately, what got me out of it was creating one rental at a time, the book, YouTube channel, and everything else. I don't have a team. I don't have employees. I don't owe anybody anything. And, I've made over 7 figures completely by accident. Most of that's margin because there's no cost just by putting content on YouTube. I've done over 14,000 videos. Those lead to books, lead to courses, lead to affiliates. I did an in-person event in Vegas last year, which blew me away. I just focused on helping people. My main platform is YouTube. And then out of that is 5, 6, 7 different streams, no ads, no mentions. I don't ask for anything. It's just continually adding value and, good stuff happens.
That's a pretty happy accident that you had.
Yeah, it's a pretty happy accident. Yeah, no kidding.
Dustin, how about you? Like, how do you leverage your online presence to generate multiple streams of passive income?
Yeah, I love working with affiliates, especially when I say especially, I don't work with affiliates that are not good for my students or my audience. The great thing about affiliates is in real estate investing, because that's what I do, is I coach people how to invest in real estate. With coaching students, there's a lot of things that they're going to be needing either in their business, services or platforms or whatever, bank accounts, so you name it. There's so many things that they're going to need to have. Now with affiliates, the great thing is I'm marketing for these other companies. Like I'm doing all the work, bringing all these people in, and then I just share with my students and my audience. Like my podcast is doing really well. We're 2 million downloads now, just me teaching people how to invest in real estate. And with the podcast and my students and the courses and the convention that I put on, I point them to these companies that they need in their business, in their whatever they're doing for they're making their money. Now with that, they don't pay any extra. And instead of this company, let's say pick affiliate number 1, they're paying for marketing through me. They're paying me for the marketing, but it only comes when I actually get somebody to sign up. So it's a huge win-win for everybody. Win for the company because they get a customer. Win for me because I make a little bit, not a lot, but a little bit of money when I send somebody to them. And it's a win for my students that they now have a fantastic service that they can use in their business. I'll give you a quick example. Creating an LLC. Usually when you create an LLC, and a lot of real estate investors create LLCs, it usually costs a couple hundred, if not, I know some companies cost $1,000 to create an LLC for you. Not saying that they're bad, it's just kind of expensive. I have one company that I am an affiliate for that it's $29 for this company to create an LLC for my students. And I think I make like $150 every single time somebody creates an LLC. So it's a huge win for my students. They get the LLC that they need. The company, it's a huge win for them because they get another customer. And then it's a huge win for me because I make money. So with affiliates, I figure out ways as best I can to put them through the blogs, like put the links, or ways for people to find them through my blog, through the podcast, even in books. I have some in my books as well. And with that, everybody wins. That's one great thing about affiliate marketing is everybody wins.
That's a great one. They say that the riches are in the niches. So MC, since you mentioned that you have books studying, like which niches are greatest? Like what are some of the most lucrative niches that you've identified?
There's a lot of them. I think any niche can be lucrative and any niche can do well. Since we're on the digital kind of niches, I found an extremely interesting one of music royalties. So just like book royalties, there's actually songs and albums of artists that you can buy in a marketplace. And you own the rights to those songs, and you get paid royalties every single time that song plays. Now, why would an artist sell a song or an album? Well, sometimes they need to raise capital for their next projects, so they sell some of the songs on a particular album to raise that money to put that into their next project. So yeah, that's been a very interesting one. And you would also notice it doesn't matter what the economy's like. People listen to music, and music keeps getting played. So I found it's a very recession resistant and economic downturn resistant one. But there's a plethora of those ones, and I think, like, again, which ones are the most profitable? It all depends. It all depends. Any one of these ones can be extremely profitable, but the digital ones, you should definitely have some of those, just to have a well diversified, income stream from many, many different sources.
Love it. Colton, what are some of the challenges that you've faced in building digital income streams, and how do you overcome them?
Yeah, so I mean, I really don't take digital income streams and all that too seriously. For me, I'm just mainly focused on what my passion is, which is mainly real estate investing, educating myself about learning about different types of investments, whether it's stock market, keeping up on the trends, or crypto. So for me, to be honest, I haven't really dedicated nearly 100% of my efforts to social media. Much like Michael, mine kind of started by accident. I started making videos because I want to go back 20, 30 years from now and look at what I've accomplished in my life. Mm-hmm. And people said, well, you should really put this online because you're teaching people how to renovate stuff and you're showing people that it's possible. And it kind of snowballed into what it is today. And I think it's because I never necessarily had a massive passion for video making or editing. My passion's always just been investing. And at the end of the day, when I was taking it very seriously and I was trying to pump out a video a week and I was trying to coach people, to me, it just felt like I was having a second, third, and fourth job. So I can't really say that I'm an expert in digital products. I mean, I have a book, because I kept getting asked, hey, how do you buy your first property? And after 30 or 40 conversations, it gets boring. So I compacted it into a 64-page booklet. And it brings in, I don't know, maybe $100 a month. It's nothing crazy. My YouTube, I try to put one video a month when I feel like it, maybe two. It maybe brings in $100 a month. It's nothing crazy. But again, it's because I don't put the effort really into it. I probably should, because I do think my lifestyle that my wife and I have built is pretty incredible, considering, we traveled for 5 or 6 months out of the year last year. We're going to do that this year. We've seen tons of amazing places. But for me, it's more or less doing what I want to do. I worked my butt off in my early 20s so I can do whatever I want. And that's just the motto I live by.
I love it. Great insights. Let's move on to our next segment.
Understanding tax implications of passive income are crucial for maximizing net benefits. Rental income is taxed as ordinary income, with deductions available for expenses like mortgage interest, property taxes, and maintenance. Depreciation of property provides significant tax deductions. Active participants in rental real estate can deduct up to $25,000 of loss against non-passive income, subject to income limits. Dividends are taxed at either lower long-term capital gains rates if qualified, or as ordinary income if non-qualified. Income from affiliate marketing and e-commerce is taxed as ordinary income, with deductions for business expenses. Sales of digital products like ebooks and online courses follow similar tax treatment. Tax strategies include utilizing tax shelters such as retirement accounts, and using loss carry forward and carryback provisions to manage tax liability. Maximizing deductions and credits through accurate record keeping and professional advice ensures compliance and optimized tax savings, avoiding pitfalls like misclassifying income and missing allowable deductions.
What are some of the most common tax mistakes people make with passive income, and how can they avoid them? Michael, any thoughts?
I think the first thing, as the W-2 employee on this, you have to understand is the tax code is not a penalty system. It's actually a reward system. If you understand the tax code, it's actually designed to reward certain behaviors. And that's something that as a W-2 employee, you need to realize you're not getting any of that love. So as several of the folks mentioned, starting a business, with the intention of generating a profit allows you to move lots of life expenses from below the line to above the line. And that is just eye-opening for W-2 employees. The other thing that, a lot of people talk about today in the real estate game and taxes is, quote unquote, the short-term rental loophole. Because the IRS treats long-term rentals and short-term rentals very different. It's different because they are different. One's a hospitality business and one is, generally at least semi-passive. So I think there's a lot of people selling the dream of, hey, let me take my rental losses, short-term losses against my active income. Because I was one of those individuals. My income was above the threshold. So any loss that I had what was called a carry forward. But again, being a full-time employee, 60, 70, 80 hours a week, having a short-term rental business and being in the hospitality business is not as easy as some people make it look. So I think I think it all starts with employees realizing that the tax code's a reward system, not a penalty system.
Dustin, any key tax benefits you utilize through your real estate investments to enhance your passive income?
Yeah, the biggest thing and it takes a while to get there. You have to work hard to get here, but it's being a real estate professional. Like, it's by far one of the best things you can ever reach because there's so many tax benefits. Like, just talking about the quote unquote loophole, the short-term property loophole. Well, I don't even have to worry about that because I'm a professional. Like, that's not even something that I talked to my accountant. I was like, hey, accountant, can I save money by having this quote unquote loophole? He's like, no, you're like, it's literally all a part of because you're a real estate investor and your professional status. Now, there's criteria like you have to have so much time working in your business, all that sort of stuff. And don't listen to what I'm saying. I just know that I'm a professional because my accountant tells me. But one of the biggest things I found for real estate investors and passive income people that want to make money is they don't talk to accountants. We are used to just looking at YouTube and watching what YouTube guy says. Well, I watch YouTube, Instagram, and I sent it over to my accountant and said, or a lawyer. I said, hey, is this right? He's like, most of the time, they're like, no, there's like 90% false and 10% true. So my suggestion is pay the pay the money. Because I don't want to be an expert in taxes. I don't want to be expert in law. I don't want to do any of that stuff. But I don't mind paying the experts because they have put in so much work and they're going to steer you in the right direction. So that's by far one of the things that people do not do that they must do. Number one, get an accountant. That's the first thing. A lawyer can come next. So get an accountant that's going to help you answer questions and all that. Make sure you're actually doing the things right so you don't get in trouble, but then get a lawyer, get somebody that that you can ask these lawyer type questions to.
MC, could you share any advanced tax strategies to help reduce tax burden on your passive income streams?
Yeah, I will. I'll say this too. I look at my tax, legal, and insurance team members as investments. I do not look at them as expenses because there is actually a return on the money that I pay for all of them. So as far as like advanced strategies, I mean, think of like, and this is very, very simple. Think of them as investments and think of them as getting a return on the money that you invest in them. The biggest thing that I've seen with folks is, number one, they don't factor in any tax calculations or think about taxes when they're looking at investing for cash flow or passive income at all. And we've got a filter where we look actually at, number one, cash flow. We look at the tax benefits that it provides or that it doesn't provide. We then look at depreciation. Does this appreciate? Is it something that you will have an exit on? And then also we look at who can you partner with? Is there skill sets and unique abilities that you don't have that you could partner with other people and then tap into their networks and their other forms of capital. I think that would be, it's not advanced, but I think most people don't think about it. Invest in good team members, and then also always factor in your decision making. Back to what is the best cash flow niche. It all depends what you need at that time. Sometimes you might need more cash flow than tax benefits. Sometimes you might need more tax benefits than cash flow. So, some niches are more appreciation plays. So you got to figure out what you need at that given point in time. And it all needs to come together. It's not in a vacuum. All of these variables have to be in alignment, and they all have to come together.
That makes sense. Colton, do you look at like the tax treatment of dividends versus your real estate? Do you make that comparison when you're thinking about like where you're going to deploy your money?
Absolutely. So first off, you guys are right. You have to spend the money on a good accountant, because there's so many things that us as Canadians, we rely on a lot of US information because that's the mass out there, right? Robert Kiyosaki, Bigger Pockets, they're all talking about US real estate. And I remember when I got started at 20, I'm like, oh yeah, I'm talking to guys in real estate. I'm going to do a 1031 exchange. That doesn't exist in Canada. Oh, okay. Right. So you have to make sure that you pay the accountants, or you talk with the tax professionals in your country, in your province, in your state, whatever it is. Now, real estate, for the most part, besides the 1031 exchange, Canada and the United States, it's pretty similar. There's little differences, but you got depreciation and you got all that stuff, repair write-offs, all that. But what's really interesting is you don't find out this particular information I'm about to get into until you pay a good accountant. But your listeners are going to find it out here, those that are Canadian, is that Canada is a very high tax country. I think everyone knows that. We're one of the highest tax countries in the world, but it's also a tax haven. You might be thinking, well, how is that even possible? Well, you see, Canada has a thing called a tax-free savings account, which you can contribute money into. There's a limit you can contribute every single year, but anything you earn in that, whether it's dividends, distributions, trades that you made, it's 100% tax-free. You can also pull out that money 100% tax-free. So my wife and I built up, these TFSAs to a couple $100,000 now, because we bought Tesla, wrote it up, sold it, bought NVIDIA, rolled up, sold it, bought Shopify, let it ride up, sold it. And then we put all those profits into cover call ETFs and dividends. So now we're getting paid $2,500, $2,600 a month, 100% tax free. And every single year we can recontribute what we pulled out and an additional, depending on the year, $15,000, $16,000. So you get this nice compound effect, and we take that $15,000, $16,000, we take it from our real estate and we put it into this tax-free vehicle. So we're taking tax preferred money, money you don't pay a lot of tax on in real estate, and roll it into a tax-free savings account. So you combine that as Canadian, and let's say you have a dividend portfolio of Canadian eligible dividends. Now, this isn't tax advice. So again, I got to say that I'm not a tax professional, but this is what we utilize. As a Canadian, you and your spouse can earn just over $50,000 per year tax-free in Canadian eligible dividends. So there you go. So now you have a tax-free savings account. You have eligible tax-free dividends. You're making $100,000, $120,000 a year tax-free, which is like making $240,000 a year. Not to mention, you and your wife can open up a corporation, a business, a successful business, and you can sell it for, let's say, $2 million. And there is something in the tax code where you guys can each make $1 million tax-free. So the misconception that Canada is a super high tax country and all this, it is when you work for your paycheck. But when you invest your paycheck, over time, you can become extremely wealthy tax-free. And something I want to share with your audience, because it's something that I learned at 20, it's that you make 100 grand a year, let's say in this country, 120, 130 grand a year, you take home 60, you work 6 months for free because half your paycheck's going to the government. So it's something to think about. Find ways to reduce your taxes legally. And that's why I got started in a house hack, because for your audience, it's the best of both worlds. You get a property that you can put, let's say 5, 10% down, but then you're renting out a unit. So then you can start writing off some property taxes, some mortgage interest, some utilities, and it's helping you bring down your tax burden.
Great advice. And with the presidential election in the US coming up, it seems like half the nation, depending on the result, may be heading up your way to Canada. Anybody else with thoughts on taxes?
I guess one thing I'll add around taxes in the U.S. is, I don't know if a lot of people realize this, but if you lived in your primary home for 2 years and then sold it, you as an individual could get $250,000 tax-free, or as a couple, $500,000. So, for example, one thing that might mean is, let's, honey, when we're young, married, don't have kids, let's do a couple of live-in flips, right? Let's get into a house with 3.5% down FHA. Let's do some remodeling. Let's have an intention to sell in 2 years. And, up to, a married couple could take $500,000 tax-free. That's just, it's a reward. Tax system's a reward system, not a penalty.
If I can just add something very quickly. Yeah, in Canada, we have your primary residence tax exemption. So there's no limit. So for example, I've tax-free have made about $800,000 in equity just moving from my primary residences, tax-free, and it's unlimited. So for the individuals in Canada, I think if, depending what government gets reelected next, they might start taxing that. So, plan accordingly, but that is another huge wealth strategy that Canadians have an option.
How many times have you moved your primary residence?
3. And about 4th. Our house is for sale right now too. So we're about to do it a 4th because the appreciation has just gone crazy where we live, and we're going to roll it right into another deal that we already have lined up.
So I love that we're talking about taxes. I have a great way to get out of paying taxes on a property and keep the property and buy another investment property. I've done this many times. So if you sell the house, which is a great idea, sell your primary residence, you make that money, which is very, very good idea because you're not paying taxes on it. But instead, what I've done is I literally keep my house that I'm living in and I do a cash out refinance, which is a tax-free loan. Now, when you sell it, you're going to get cash, right, in your pocket. But what you want is the cash and the property that makes you money. So what I do is you do a cash out refinance because it's a loan. IRS does not tax loans. And then you take that. I've done this many, many times, taught my students how to do this, where we take that loan and then we buy another property. Now you might be thinking, well, your mortgage goes up. You have to pay more money because you took out that cash out refinance. Like, that's a good point. But I buy another property that makes more money than that increase in mortgage payment. That's passive income. So it pays for the mortgage. It's tax-free. I buy another property, I keep the old property, and I make money in passive income. It's a huge win-win-win all over.
Absolutely. I just want to tell people, be cautious with how much debt you take out, because in Canada, we're experiencing our 2008 moment right now. And I know many individuals who pulled out every little bit of equity they could in their BRRRR, and now they are underwater. Foreclosures are rampant now here in Canada. So it's an amazing strategy. That's how my wife and I build our wealth, but you need to be careful with the amount of debt you are taking out.
Colton, you're 100% right. When I first started investing in 2006, I saw in 2008 so many people go bankrupt because they were way over leveraged, which means they had lots and lots of loans, lots of money coming out. Well, as soon as the economy started to stall, they had problems. But what's funny is I was buying lower priced homes that had a good amount of cash flow. Plus I was trying to get as little loans as I could, but I made more money because the rents went up and I made more money over time, but I did not have this huge burden of this big mortgages. So I see that potentially happening where people are getting way over leveraged, which means too many loans out. And in fact, one quick last thing I'll say is I had a student I was just talking to literally about 5 minutes before I jumped on this call. He was having an issue. So he has literally $1.6 million in debt. He gets $22,000 a month coming in, but he only makes $2,000 a month in passive income out of the $22,000 because he has a lot of loans going out. So we worked out a way for him to get rid of a lot of these loans because I said, if you don't have cash flow, that is when you lose the game of Monopoly. If you think about playing Monopoly, you buy the boards, you buy the houses, and eventually, like my daughter literally just learned this lesson 2 days ago. She kept buying houses or property after property after property, cash flow going out, buying houses. Then she lands on one of her brothers, he only has like one or two, and she doesn't have any cash. And so she has to spend this cash and then start mortgaging her properties to make more. So you're 100% right. Cash flow is by far one of the biggest things, and don't get over leveraged.
Good word of caution. With that, let's bring it home and go to segment 5.
Effective risk management and diversification are crucial for maintaining stable passive income. Diversifying investments across asset classes, such as stocks and bonds, balances risk and return. Real estate investments should be varied by location and property type to mitigate local market risks, while commodities and alternative investments add further protection. Geographic diversification reduces exposure to regional economic and political risks by spreading investments across domestic and international markets. Sector diversification, involving industries like technology, healthcare, and consumer goods, helps cushion against sector-specific downturns. Key risk management techniques include ensuring significant assets and maintaining cash reserves for liquidity. Regularly reviewing and adjusting the portfolio ensures alignment with financial goals and market conditions. Consulting with financial advisors aids in creating a tailored, diversified portfolio that aligns with individual risk tolerance and objectives. Implementing these strategies enhances the stability and resilience of passive income portfolios, ensuring long-term financial security and growth.
Yeah, so I think we've been talking about diversification. That's come up since segment 1. MC, what are your tips for diversification techniques that are effective for really ensuring your passive income is steady over the long term?
I think the best advice that I can give your listeners and viewers is to know the difference between saving, investing, speculating, and gambling. So in a well-diversified strategy, you have to have obviously some savings, and then there's investing. And then if you know what you're doing, you can be a very good speculator. And it's very important to understand the definitions of these things. I think this has been so distorted in our world that this is why there's so much confusion. So when you save, you're putting your capital into a vehicle where there's not a lot of risk, and therefore you're getting a very conservative return. So the principal's never supposed to go down in a savings vehicle. And because it's a savings vehicle and you're not taking on a lot of risk, your return's very, very, very conservative. And you need some of that in your strategy. And the second piece is investing. Investing is when you put capital at risk and you could lose some or all of it. That's what, and you're doing that. You're taking on the risk in the hopes of a higher return. The third piece is speculation. Now, speculation, you can do very, very well as a speculator. So what a speculator does is a speculator does his or her analysis of the environment and see massive bottlenecks and distortions, usually created by governments, in the economy, and position themselves on the right side of those. They can also see trends up and coming. Hindsight is 2020, but even at the time, it doesn't take a rocket scientist to figure out that Bitcoin was actually going to get a lot of traction after the events of 2008, 2009. That did not take a rocket scientist to figure that out. Most people got a rug pull, and were looking for other options, and were, they were looking for different solutions. So that's a trend that you can see coming, and get on. As a speculator, other speculative opportunities right now, we're shutting down an energy system that the world is currently relying on right now. That wouldn't be a problem if you had another existing energy system already up and running and built out that you could switch over, but you don't. So there's a massive bottleneck. So there's a speculative opportunity there. And then, of course, gambling is where you look at probability games. You place bets, and the house always wins in that one, right? So as far as from a diversification strategy, you know when you're saving, know when you're investing, and know when you're speculating. And don't really gamble unless it's a couple of $100, just to have fun, or a bingo night with some loved ones. But I would say from diversification, people should know that you should have savings. You should have capital in a place where it's protected, principals guaranteed. You're getting a very, very conservative return. Why? Because you're going to need that capital to go out in either fixed positions that you have or investments that you've already made when you need liquidity, or you can capitalize on other opportunities. You should be investing in certain asset classes, right? Getting high returns, getting great tax break, having appreciation of those assets and so forth. So you should be doing all of those different things. So when you think of diversification, don't only think about investing, because if you have 100% of your capital invested and it's diversified, when you have systemic events, you're still going to get wiped out. That's when you're going to need some liquidity and savings to fall back on.
I love the intentionality. And when it comes to gambling, as Wesley Snipes once said, always bet on black. Michael, how do you ensure that your investment portfolio is resilient to economic downturns?
I'm going to go the Charlie Munger route and really talk to my W-2 employees, because again, that's who I was. That's what I've done. I think too many of us try to diversify too early. I really believe getting wealthy is 3 steps. Step 1, creating disposable income. Step 2 is becoming elite at something. So what does that mean? If you want to go become elite at crypto, go all in. You want to become elite at wineries and wedding venues, great. You want to be a short-term, single family home, great. You get really, really focused on something and then watch the basket. I think too many W-2 employees try to dabble in 5 different things and they don't go anywhere. If you're elite at something, if you become elite at something, you can almost see around corners. You can see value add. You can see something that the normies miss. And then if you do that for a decade, you're going to be wealthy. It's just simple math. So diversification for me didn't start until after I was retired, after I had enough. Then I'm like, okay, well, let me go try these other things. So I may be the oddball here, but I think most W-2 employees should pick their thing, their passion, their interest, go all in, become the top 5%, 1% in that thing, and then use that to your competitive advantage for a decade. That's what I would do.
I would definitely agree with that. I think it's Warren Buffett talking about Berkshire Hathaway. He said diversification is for people who don't know what they're doing.
Exactly.
I absolutely agree. So my number one bread and butter way that I make money is through real estate. I can literally do residential 4 units and below, like in my sleep. I've done it so many times myself, coached so many people how to do it, but that's my bread and butter. And like Michael was just saying, I literally, before I got here, I was trying everything, seeing what would stick. But then for me, what was the best thing was when I bought one property, it made money for me without working. It was the easiest way to make money. It continually made money. And so I love the idea that you go so deep, like instead of being a mile wide and inch deep, you be a mile deep and an inch wide. You be so great at your one bread and butter way to make, say it's writing books or creating songs, whatever it might be. You go that route, you become the best at it, and then you diversify. Now, I personally, I don't just have, I have 30 plus properties now. Then with that, I also have hotels. I invest in hotels, just bought apartment complexes. So I've since branched out. So my suggestion, just like Michael, be a mile deep. And then once you have extra, then you can start getting into different asset classes, different affiliates to courses or whatever it might be.
Yeah, I love that. And I think that if you do become extraordinary at what you do, once you are elite, odds are that you're surrounding yourself with other people who are elite, and you get many more great ideas, many more great insights. And that's why you tend to see things that others do not. I want to ask Colton, how do you approach asset allocation? And do you think about, do you need to maintain a certain amount of liquidity and flexibility in your portfolio?
Great question. Yeah. So obviously, like I said, don't over leverage, right? Always make sure you have healthy debt to equity ratios. But something I wanted to just point very quickly that MC said, and it's a term he said was rug pull. And that usually comes with crypto. That's like everyone knows a rug pull they associate with crypto. But what people need to realize is that every single person, at least living in Canada, United States, and most of Europe, has been rug pulled due to currency debasement and inflation since 2020. So you have to save money. Absolutely. You do. But you have to have the intent to invest that money. Because if you just save it, you are losing money every single day because they just continue to print it, and they're not going to stop anytime soon. So I just want to make sure your audience understands that it's great to save money, save it, but save it with the intent to invest. When it comes to diversifying, I love what Michael said. People diversify way too early. It's 100% spot on. Like for me, when I bought my first property, I was working 3 jobs. I had no other time than just to work on real estate. So I was focused on real estate for 2-3 years. I was buying, renovating, refinancing, repeating the whole Burr method. But then something started happening as I built up 2, 3, 4, 5 properties. I started having cash flow come in. All of a sudden I can let go of one of those jobs. And what that gave me was more time to start learning about dividend investing, cryptocurrencies, other types of investing like private lending, whatever it is. So a strategy, and I don't really know what to call this type of strategy, but it's worked for us marvelously. And that is, when we did a Burr deal, let's say that we are all in 80 grand to that deal, and we were able to pull out $100,000. So we made $20,000 tax-free. Something we did from the very beginning was we would take $5,000 and we put it into dividend paying stocks to get that consistent monthly or quarterly income, because real estate can be unpredictable at times. And then we take another couple thousand just because I was into Bitcoin, right? And I would put $1,000, $2,000, $3,000 into Bitcoin at that time. So I was diversifying, but 95% of my effort was still focused on real estate. And what that has done over the last 10 years has created multi-million-dollar portfolios in different asset classes by accident, right? We were just putting a little bit of money at a time, and it compounded naturally. So I think diversification is extremely important when you start making a lot of money. But like Michael said, focus on your craft first, right? If you're really good at real estate investing, focus on that. When you have a little bit extra time, let's say an extra 5 hours a week, study stock market, study index funds, right? Study something and maybe take $1,000 from that profit you made on that Burr deal and put it into there just so you can start getting a little bit of skin in the game. I'm just talking from sheer experience. It's worked for us, and it's a strategy we continue to do to this day.
Love it. MC, any closing thoughts?
No, I think this has been a great conversation with a lot of different perspective and a lot of great insights that are very much in alignment. So I appreciate the opportunity to come on and have a conversation with everyone. This has been great.
Michael, closing thought?
I would let the audience know that it's possible, right? None of us here have any superior intellect. We're just a bunch of folks that focused and executed. We do have time on our side, so we've been down the path, so we can tell you what the results are. But we all start somewhere. It all starts usually from an epiphany that, hey, I don't want to work 40 hours for 40 years to live on 40%. So wake up, take some ownership, extreme ownership, and just get started.
Okay, well, I want to thank the panelists for joining today. Thank you for the inspired money makers for watching, for listening, and just some really quick takeaways. I think that we covered like starting small. You can just start with like $20 and an investment account going after dividends so that you're generating some monthly or quarterly income. And then as you grow, it's about focusing on living within your means so that you have like this pot of money that you can put to work and have a mentality that you can generate passive income while you're sleeping, while you're traveling. And we talked about passion. It's identifying what are you interested in, and can you come up with a digital product or invest in a multifamily home to generate passive income. So it takes some introspection, knowing yourself, and then also looking at opportunities and talking to mentors and different people for ideas. And all the panelists shared fantastic ideas, not only ideas, but ones that they've executed on. You can find Michael Zuber at his YouTube channel, youtube.com/one-rental-at-a-time. MC Laubscher, you can find at cashflowninja.com, among other places. Dustin Heiner is at masterpassiveincome.com, and Colton Lukey is at youtube.com/financialfreedomlifestyle. I encourage everybody to follow our guest panelists today to learn more. And once again, thanks to the panelists. Inspired Money is going to go live again this week. on Wednesday, July 17th, with a panel discussing financial independence, retiring early, and living your dreams. I think it's closely connected to this episode, just a little bit different. But I hope that you can join us then. I think we're going to have Jordan Doc G. Grummett back on the show, as well as Christy Shen. She's from millennialrevolution.com, author of Quit Like a Millionaire. Thank you, everyone. Until next time, do something that scares you, because that's where the magic happens.